Thank you. Good morning, everybody. Um, when I first got a call from Akhilesh, I thought I was an odd choice for a speaker. I've not been a professional investor. I haven't started a company where a professional investor has invested. I've sold a couple of companies to public companies which you might have been investors in or considered investing in, Future Group, Open Table, but that's a bit of a stretch. Then Akhilesh said, I read your book, and I think investors need to hear this story. And this was early days of the book. It's just been out a couple of months, 3 months. And I said, oh, here we go again, right? What's interesting is I wrote this book for entrepreneurs and for the Indian digital consumer, the folks who shop on Flipkart, shop on Snapdeal, take an Ola, who are probably wondering what just happened in India, what happened in the Indian startup ecosystem in the last year or two, what suddenly changed, because something suddenly seemed to have happened. There's a ton of funding, there's a bunch of discounting happening. So I wrote for them, and then accidentally I found that investors seem to like the book, and they find some of the theses in the book interesting. It's a bit scary for me as an entrepreneur that I thought, investors would obviously know all of this stuff and would probably, I have more to learn about their thesis. I'll give you actually one surprising example where there's a top-tier VC, a friend there, who has invested along with Tiger in a couple of companies, as well as SoftBank. He said, after reading your book, I feel like I understood Tiger a bit better. And it was extremely scary to hear that, but it was flattering. So here I am. My goal is in the book I've told a lot of stories. The Indian digital consumer, I thought, likes stories. As a product developer, I like testing ideas very early in the game to see what works. And I found that telling stories is a much better way to reach out to more readers than sharing data and analysis, which I'm sure in this room we are very, very, open to that. But I told a bunch of stories in the book, and I'll leave you to the book to read those. What I want to do today is jump to the end of the book where I share my opinions. I stop telling stories and share my opinions of where you should invest, where you should not invest, right? Or where you should start companies and where you should not. And these are opinions. In that, I'm going to pick the part where I'm talking about the myths. I think there is investment thesis and operating thesis that has perpetuated our ecosystem, especially in the last couple of years. Not only in the last couple of years, but especially in the last couple of years. It's been going on for the last 10 years since funds set up shop in India, both VCs and PEs, and started looking at tech. And I'm going to share, why I think these are myths, and hopefully save you a ton of money if you agree with me that these are sure short ways of losing a lot of money very, very quickly, right? So let's get started. Well, so the first one is the big one. It's India is the next China myth. If you think Indians could copy, the Chinese are masters at reverse engineering. Just look at that picture there. And it's worked out for them, right? If you look at the Cisco of China, it was not Cisco, and it wasn't for lack of trying, right? Turned out to be Huawei. If you look at the Google of China, it didn't turn out to be Google, not for lack of trying, Sina. The eBay of China was not eBay, it was Alibaba. The Facebook of China was not Facebook, Tencent. The WhatsApp of China is WeChat. The Uber of China might very well not be Uber. It might be Didi Kwaidi. The Amazon of China might very well not be Amazon, might be JD. The thesis that I talk about in the book that Tiger came up with in the early 2000s was the this of that investment thesis, right? So Facebook of China, this of that. So imagine a spreadsheet where the rows are market spaces, let's say online classifieds, jobs, matrimonials, online travel, e-commerce, and so on. In the columns, you've got regions. You've got Africa, Middle East, Eastern Europe, Latin America, China, India. And you've got all a matrix of spaces to invest in. So YouTube of China, search engine of Russia, Travelocity of Brazil, and so on, right? And Tiger invested with that thesis. This was actually an internal thesis called this of that investment. And over a decade, created tens of billions of dollars of wealth with this thesis. And in China is where they really struck gold, right? In this thesis, I'm taking Tiger as an example, but Tiger, SoftBank, DST, Naspers, Rocket Internet, all of them are believers in this thesis over a long enough period of time where they've made a ton of money with this thesis. Now, my trouble with this thesis is just because JD and Alibaba went public in the US and suddenly there's $100 billion of wealth, and what investors love most is when I've made a ton of money in a once-in-a-lifetime sort of way, the next thing I want to do is replicate it, right? Oh, of course, now we know the code, let's make it happen again, right? So there was this mad rush to say, look, it's at least worth 5% of that money to put a punt on India, which is possibly the only next China, because look at 1 billion consumers, look at the internet penetration going into double digits now. That's where China was in 2008, remember? That was the best time to invest. Look at the GDP growth. Look at the new government in 2014, which is decisive, business-friendly. Look at the demographic dividend. All the macros look good. Don't look at the lack of homogeneity, like in China and the US. Don't look at the infrastructure that's available in order to build network effects businesses. Just look at these micro things because suddenly I have all this liquidity and I'm looking for the next China, right? Unfortunately, what's happened in India is the Google of India, the Facebook of India, the WhatsApp of India, the Cisco of India, the Microsoft of India, have all been these companies. Investors have tried to invest in a Tejas Networks or a Guruji.com. I don't even know how many of you have heard these names. A Minglebox as the Facebook of India thesis. Now a Hike Messenger, right? The thesis of this of that, where the column of India is now suddenly, here we are, we've arrived, it's our turn now, is flawed, in my opinion, right? And it's a thesis which is half true, and it's a sure shot way of losing money. There is, let me actually move on to the next, and we'll try and address these with the other myths. The second myth, which especially took over last year, or between 2014 and 2015, was, this is Jason Bourne, who's chased by terrorists on one side and chased by special agents on the other side, jumping from a rooftop into a window, not knowing what's on the other side of that window and how hard that window is, and he makes it, right? It's a movie. It's a pretty cool movie. I watch it over and over again. I want to be Jason Bourne as well. Don't try this at home. The whole limited window of opportunity theory, I was a kid who started my first company at IIT when the internet bubble was shaping up. And I believed there is a limited window of opportunity, and all the big internet companies in the world will be built right now. Either you catch the bus or you miss out. So I know exactly how that feels. A lot of us felt that way in 2014 and 2015 in India. Now, the way it played out in the US is there's about 200 loss-making internet companies that went public on NASDAQ between 99 and 2000, or between 98 and 2000. Most of these companies, starting March 2000 till the bottom of the bubble burst, NASDAQ lost 80% of value. Most of these companies went bankrupt. But what happened over the last 20 years is now if I tell you that all the biggest internet companies that were to be built have already been built, you'd know that I'm a fool, right? With every passing year, the pace at which the fastest billion-dollar company has been created. Let's not kid ourselves. We are here to build billion-dollar companies. As investors, we want billion-dollar companies. The pace at which billion-dollar companies have been created has only accelerated. And that record has consistently been broken by tech companies, what you would call internet companies. The number of internet companies that have increased, billion-dollar internet companies, has only increased as time has gone on, right? I think the same is going to happen in India. If you look at all the fear of missing out sentiment deals of 2014 and 2015, they are all coming back with far more sane valuation expectations, with far more patience for diligence, and listening to things that are broken and need to be fixed if this ever has to become a large company. So there goes your limited window of opportunity myth, right? There are more people who've either lost money already or I think this story plays out over the next 6 to 12 months, will lose money who probably operated through this whole limited window of opportunity. Because most often you hit that window or the wall and go splat. This guy holds the world record for the biggest house of cards. After he built it, he's watching that beautiful thing go down with a blower to celebrate it. So here let me give you an example of one of the companies which had the this of that thesis and was early into India, even earlier than Tiger, SoftBank, DST, Naspers, etc. A company called Rocket Internet. Rocket Internet has invested about $500 million so far between Foodpanda, Jabong, and FabFurnish. FabFurnish is sort of cut down operations and about to be sold for a pittance. I think Jabong and Foodpanda, the only reason they've been, there's been a huge correction in how they're running the show. The only reason they're still being kept alive is to salvage the previous investment and sort of flip it to another player who cares. And the market doesn't have enough depth to bail them out of that sort of scale in valuation, especially with cash involved. Now, for the Indian tech space, $500 million is a lot of money. It's not small money. It's a large percentage of what tech startups used to get. A lot can be done with that money. But it wasn't too big to fail, right? If you take the number of companies which have raised more than $100 million in India, it's about 20-odd, couple of dozen companies right now. My bet is that many of them are still, they're not past the too big to fail. Over the next 6 to 12 months, my forecast is that even with the largest e-commerce players of India, we will potentially see failures happen. So in the book, I've laid out this poker game, which Jeff Bezos, Leaf Excel of Tiger, Masayoshi Son of SoftBank are playing. And in that game, I talk about all the events that happened over the last 4 years and how it's a betting game between them. And in that book, 2016 is when the river, the last card, plays out. Okay? So it's not in the book because I was writing this last summer. I think where the last card seems to be playing out right now is in year 2015, Amazon doubled in market cap. JD and Alibaba, the funds that kind of led Flipkart and Snapdeal, have taken about a 30 to 40% haircut. Amazon is still relevant. It's not been bluffed out of the game. And it has the highest stack of chips sitting there. Likely the best unit economics as well. Where the biggest moats are funding and not the network effects that we talk about, not consumer loyalty, not control over merchandise where you have margins. There's largely parity on those fronts. You could argue that in terms of technology, Amazon is ahead because of the 20 years of building it out for the world. My bet is, that hand is already won. And we'll see that play out. And this too big to fail will likely be, it won't be speculation anymore. Myth number 4. How many of you recognize this picture? Okay, one guy. Thank you. Dr. Strangelove, how I learned to stop worrying and love the atomic bomb. So it was a dark humor where America has built a bunch of atom bombs. And they're coming up with reasons to use it. If you have a bomb, you need a war, right? If you've built so many bombs, you've innovated so much, if you have a hammer, everything looks like a nail. So here's this cowboy who was so eager to launch the first atomic bomb of the world, which obviously led to, once more than one person has a bunch of bombs, all it takes is one bomb to start it. And then the world is a nuclear holocaust in the book. And this guy's actually riding this bomb as a cowboy and waving his hat as the bomb goes down, right? So the example I want to give here is this young, ambitious, really smart guy out of IIT Bombay who started a company with about 13 founders. I would say he's more of a politician than a businessman, but let's say he started a company with more than a dozen founders. By the time he raised $100 million, close to that from SoftBank, they were down to 10 founders and very cowboyish sort of behavior. And he said, well, I have this war chest now. I didn't need this money, but now I have this money. He had no idea that a company called Saofun from China had gone public, that Alibaba had gone public, and suddenly SoftBank is sitting on a ton of cash, looking for a real estate play in India. It's all inherent value. Look, I'm God's gift to mankind, so I'm a cowboy, and here are guys who want a piece of the action. He started 10 different businesses as soon as he got the funding, because 10 founders left, right? So each one needs to be CEO. And he's like, I'm group CEO. Started spending money on all these initiatives. More companies die of indigestion than starvation. If you build a war chest, if you have a ton of money, you'll figure out a way to use it. That will lead to cultural mishaps, that will lead to structural bad behavior. There's something to be said about stay hungry, stay foolish. Of course, the company I'm talking about is housing.com. Unless you're reading the Economic Times, it's a bust, right? This is too close to home. I'm a Powai guy. I know a bunch of really sharp people who joined that company and even were there from the start. Most of them have left. About 80% of the crew has been fired. The company still lives on, and my guess is, the same foreign investor thesis, which was really distant from the reality of the company, now wants to go tell the foreign investors, oh, it's not a total loss. We'll find a way to salvage this, and basically they don't want to say I'm writing this off right now, right? That's my view on this. But wherever that lands, the whole war chest thing sounds very romantic, but usually ends up losing a ton of money. This is one that really cracks me up when this comes up over and over again, and sometimes the unicorn CEOs in India talk about this as well as a metaphor. Well, Amazon has been public for about 20 years now. We can look those financials up. They have this really powerful flywheel thing of if you invest the last dollar of your profit into cheaper prices, that will lead to more consumers, that will lead to better supply, better logistics, that will lead to cheaper prices, and that flywheel sort of rotates. So the e-commerce model that you could say Bezos invented was actually a deeply financial model of how do you keep operating profits at zero in order to leverage revenue growth, right? And then how do you use that to create free cash flow and so on. Yes, Amazon did not make money, does not make money on the transaction. The other part of that coin, which is as important, if not more important, is Amazon does not lose money. Amazon never lost money. In the exuberance of 99, 2000 as well, Amazon did not lose money on operating margin. These are public company numbers. Amazon raised, if you were to guess how much money Amazon raised before they went public, anybody here? You probably know this. Just order of magnitude. Just you can yell it out. Okay, nobody wants to take that shot. 20, yeah, closer. $10 million, less than $10 million. You can't do that unless you know how to manage cash. There's no debt till, right? For less than $10 million, you take a company public. Sure, it was the late 90s, right? And then they raised, I think, between 2 to 3 billion in debt after that. And of course, in the public markets, they raised a bunch when they went IPO. And then the first time they were profitable, not on operating margin, they were always profitable. The first time they were profitable overall was, I think, the last quarter of 2001, which they reported in Q1 2002. They were a profitable company. And over the next 12 months, they returned that entire debt. That company's been alive for 20 years, and it's a really large company. You can't do that unless you know how to manage money and you know how to make money, right? JD, the Chinese invented subsidies and discounting, and we borrowed a page from that. So we are here looking at US successful models as well as Chinese successful models, which is great. We should look at them, we should learn. JD is public. JD is operating, it's inventory-led e-commerce, minus 2% operating loss. Indian e-commerce is operating at, they're not public, so there is some range I'll have to give you. It's operating at minus 30 to 50%. Operating margin. I'm not talking about net. So the whole thing about, oh, look, we're like Amazon. They never made money, but they never lost money either. Right? It's one of the biggest misses, I think, which, it's a great political statement to make. It's a great way to rationalize something, but I'll be surprised if investors are actually buying this logic. And actually what happened, I think, in late 2014, early 2015, is some of these e-commerce companies tested the waters on Wall Street to see how far are we from a NASDAQ IPO, right? These were good times, sure, why not? So people pulled up financials. There are private equity funds that pulled up financials of, let's look at where Amazon was at that valuation. Let's look at where JD was at that valuation, right? Because these are the equivalents. And the financials were chalk and cheese. They were just very different. It didn't look anywhere close. So, and that story is something which, during the 99 bubble burst, we saw the stock price fall, on a public website page that you could reload. These things are happening in the boardroom, so we're not aware of these, but this is done and dusted. It's already playing out now, right? The potential of these companies to go public, now they know what it will take to go public in the US markets, and I think at these valuations, they can't go public in the Indian markets. It's just very far away, and it's a really tough story. So something's got to give some time. And I think it plays out in the next 6 to 12 months. The new government will change everything. I was in Future Group when the whole FDI uncertainty was happening in multi-brand retail. So I want to focus on FDI as an issue. FDI and multi-brand retail, the previous government, said we should have it, then retracted from it, then came back with a policy which I think was a stillborn policy. I think FDI and single brand retail has played out, but FDI and multi-brand retail, there haven't been much takers since that policy over 2-3 years ago, and the current government opposed that policy. And from my understanding, the philosophy behind that was, there's a couple of things which are core to that. One is, we can't have foreigners own the India consumption story, right? I'm not saying it's right or wrong, I'm just saying my understanding of the thesis behind the FDI and multi-brand retail should be disallowed policy framework. And the other was, we should protect our markets from being flooded by cheap Chinese products, which kills local manufacturing, right? So therefore, make in India makes sense, manufacturing our own products makes sense. At that time, I was running futurebazaar.com for Mr. Biani. And we were obviously exposed to all this. FDI and e-commerce became an issue at the time because there was huge funding happening in e-commerce. It was in the front page, started being on the front page of newspapers then. At the time, we were ahead of Flipkart and Snapdeal, but then Flipkart and Snapdeal got huge amounts of funding, and it started being a thing, right? So the government clarified at the time that FDI and e-commerce is not legal. It's not. So then all these e-commerce companies set themselves up as a marketplace model, etc. But it's, everybody knows it's, right? So whatever the loopholes, e-commerce in India is foreign owned. Majority of these companies, not just majority, 80 to 90% of these e-commerce companies are owned by either foreign funds or are foreign themselves. Flipkart is a Singapore company. The cap table is in a Singapore holdco. I'm just saying this violates the government's philosophy around FDI. And the other is, look at most of the products that are being sold through e-commerce and the growing numbers right now. These are cheap Chinese products with a very efficient sourcing model. If anything, a government who is friendly to e-commerce, to business, should clarify the policy. Operating through loopholes for such a large business is likely to fail. Now I'm going to read out Amazon's public market risk statement that they made around this issue. They said, although we believe that these structures and activities comply with existing laws, the structure of how e-commerce companies are to comply with FDI, they involve unique risks. There are substantial uncertainties regarding the interpretation of PRC and Indian laws and regulations, and it is possible that the government will ultimately take a view contrary to ours, right? And that's their risk to the market with regard to India and the policy framework. The largest funded companies in Indian tech, e-commerce and taxi, have policy uncertainty. I don't think that's going away anytime soon, because if you clarify that, then it comes with ownership changes and what is the merchandise that's being bought online changes, you can't take that bet because money stops coming in, and you can't say it's legal because then it becomes a political issue. So I was at Startup India where our Prime Minister was there talking about Startup India, Stand Up India. It was very inspiring. Earlier that day, the the Minister of State Finance was moderating a panel with all the e-commerce unicorns on the panel. And it was a very friendly, there's no talk about FDI in e-commerce or the elephant, nothing. All day I heard every single talk. And there was a lot of, sort of congratulatory stuff happening. What was ironic was 48 hours later on Monday, the Enforcement Directorate raided all the top e-commerce office. And that's a routine event that's happening, right? Every quarter, every half a year, the ED goes and raids e-commerce companies for some lack of compliance. And then we keep buying products at discounts. Life goes on, and then again, the cycle repeats itself. So why can't we just clarify those policies? If we don't, someday it catches up with you and gets in the way, right? So I would suspend the belief of the new government will change stuff. They can delay stuff. They can procrastinate stuff. I don't think they can fundamentally change how, change the policies around e-commerce and taxis. If they could, those would be low-hanging fruits, right? They would have done it already. Monopoly. Loved this game as a kid. Who doesn't want to build a monopoly? I'd love to build a monopoly. As an entrepreneur, you'd love to invest in one. The examples that come to mind are, Facebook didn't make money for the longest time, but pretty much became the way to be in touch with your friends, Google, and so on. So you create a new market. Even if you don't make money, eventually you'll figure out a way to make money. Either because you own the margin model, if it's a variable cost business, or you don't have a variable cost, like a Facebook or Google, right? So you can say, I'm going to bet on some future profits will come sort of theory. I think it'll be a mistake to believe that any of these borrowed market spaces in the this of that spreadsheet for India are going to be monopolistic businesses which will eventually become profitable. Right? Even for them, even if we give them a benefit of doubt that fine, e-commerce will remain a small single-digit % of overall retail and therefore far from monopoly, can you command future margins in a market where the loyalty of customers is not clear, the merchandise is not owned by you, or it's a low margin traded commodity merchandise. If it operated at zero operating profit, I would say we could give that benefit of doubt, right? Eventually some margin will come. But if you're operating at minus 30%, minus 50%, and you're creating a certain habit of giving discounts, I think it's exactly the opposite. It's not like the profits will come, and it's not like they have created this market. There was e-commerce before them, and it's more of a, if you have a hammer, everything looks like a nail. I want to own India as a territory, extended territory beyond US and China and the rest of the world for e-commerce. E-commerce will happen in India. An American company and a Chinese company are competing to own that territory. It's a proxy war happening. It's not a monopoly creation that's happening, right? And the whole belief of it's a network effect business where winner takes all, sorry, not in India. I haven't seen a national scale business. Okay, maybe we haven't built tech businesses in the past, but I do not believe that India has the homogeneity required for a winner take all network effects tech business. I believe it's going to play out in a far more fragmented way. And even if it is a winner take all, it's not going to come from negative operating margins. Just last two. Here's another thing I've heard a lot, especially in the last couple of years. Taxi for sure got bought by Ola. Freecharge got bought by Snapdeal. Myntra got bought by Flipkart. big acquisitions. Some VCs made money, some angels made money. So we have exits, we have liquidity. Look, exits keep happening. Zorooms got acquired by Oyo Rooms. I don't think these are exits, this is consolidation. Fine, money is changing hands. It never did before. There's more velocity of cash changing hands as well as part of these big stock deals. It's the hati ke daant. There's a huge valuation number, but sure, there is some teeth under that. I get that. There's also secondaries happening, right? There are VCs who have sold their Indian unicorn stocks in secondaries. Some pension fund in some part of the world who really wants to have a piece of India in a sure short market is willing to pay secondaries and get some liquidity in the market. Unfortunately, I've also been in boardrooms where a VC just funds a company, and the first meeting after the funding round is, all right, so what story do we need to create so that those global funds do the next round? Right. So when you don't have a healthy IPO exit environment with a deeper accountability, it very quickly becomes a Ponzi scheme. Very quickly. And I've seen this from the inside where the large fund is saying, look, I'm putting a punt of these many $1 billion, and I'm looking for late-stage investments in these spaces. The VCs go, how do we dress up our companies to get that money? The angels go, how do we find deals that these VCs can fund? And the entrepreneurs go, they walk up to angels saying, "Aap bata do kahan funding mil rahi hai aajkal?" Right? And this is usual. This is, entrepreneurs would come up, IITians would come up saying, tell me the market space, I'll run. I'm a competitive IITian. I know how to win races. In fact, I feel a lack of identity if I don't have a race to run, right? Forget this blue ocean strategy and go create your own market and figure out a customer, solve it uniquely, and all of that. Give me a race, I will win the race. Ab dal ke to dekho, sir. We need IPOs to save our lives. Okay? There are about 5,000 tech IPOs in the US. There's hundreds, close to 1,000 Chinese tech internet companies that are IPO between Hong Kong, Shanghai, and US. India has produced 3 internet IPOs. And I'm betting that none of you are at the edge of your seat to buy those stocks anytime soon. I'm talking about, you know who I'm talking about. Love those companies, love those guys. It's taken a lot of blood and toil to build those companies. Thank God they've got there. We need so many more of those. Right? Finally, here's the part which surprises me the most. Okay, in my last 2 companies, I've had people who've had stock options, who've made more money from that stock than their lifetime worth of salary combined. I have done that myself as well. I'm on my 4th startup now. I'm drawing 0 salary. I know the kind of jobs I've given up to do this. And I know it's going to be worth it. I value stock. The guys who worked with me come back to me saying, I want to maximize my stock. Tell me how I can do that. People absolutely value stock. When I was a kid at IIT, I used to hear Nandan Nilekani and Narayan Murthy come to campus and talk about stock options and how their secretary and drivers have stock options. And when the company went public, people made money, and they were proud of that. And stock options are very much part of the whole ethos. Now, what's happening in the Indian unicorns is I'm willing to sell 90% of my company to investors, and I can't even give 10% to those people who are building those companies from the inside, right? I'm out there telling stories and raising money, willing to dilute. And I'm saying, look, Indian employees don't care about stock options. There are times when I'm promising them stock options, but I'm giving it to them 3 rounds later when the company, all the upside is gone. How will those guys value stock options? When they see that their founders have made millions and sometimes tens of millions of dollars, when their stock is illiquid, it's worthless, and they have a very little. Even at that valuation, it's not a whole lot. And they think they're better, as they should, in any great company that's get built so fast. They leave the company at the first available opportunity when they can raise money from VCs. They figured out a market space where they can repeat this cycle. So the trouble I'm facing now is I'm seeing this become a part of our ecosystem where the entrepreneur behavior is people don't care for stock options. I want to retain all the equity. I should go over dilute. There is no IPO environment, so this valuation is just a way for you to make a fraction in secondaries eventually, or worse. There are cases where you've got relatives of the founder setting up merchants who sell on the platform at 100 rupees and buy it at 80 rupees because there is a negative gross margin going on. And there is this known way to leak the company out of money. The investors don't have time because there's a limited window of opportunity, right? There is this war to be won. And the company is being leaked out of money by relatives of founders. Some of these companies have even been talked about in the press. And this is not some local press, this is mainstream press. And after that, the companies get funded. There are VCs who, and these are first-hand accounts I'm talking about. There are VCs who say, let's announce a 10 million round when it's actually a 5 million round because it's a crowded market. We want to scare the others away. There are companies where they've planted employees into a competitor to learn trade secrets, to copy code, to copy a customer list, come back, build the same thing. An investor who wants to invest in it, it comes up in diligence that the company has been sued. And then a reputed lawyer gives a statement saying, look, India hai, kuch nahi hoga. He has an opinion letter saying, it's fine. And the investor chooses to overlook that fact and fund the company. My trouble is, in our own way, I think all of us in this room who are probably invested in tech or are looking to invest in tech kind of know what I'm talking about. This is not a one-off case. This is pervasive. This is happening. It's going to catch up with us someday. I think if we are betting on this for the long term, if you're betting on Indian tech startups for the long term, we owe it to ourselves to sort of keep the tabs on integrity and make sure it's a clean ecosystem. Sure, there are troubles with enforcing laws and the judicial system and the pace at which we do it and so on. But there is personal accountability that we can bring to the table and start cleaning up this mess. So I'll stop there, and thank you very much for listening.
Thank you, Kashyap. Questions from the audience? Anybody who's lost a lot of money recently? Yeah, the gentleman, yeah.
Hi, good morning, everyone. I'm Anshul Jain from Mahindra & Mahindra. My question to Kashyap. Kashyap, like even before coming to this room, I had not really seen you or heard about you, but I know a lot after the Golden Tap and all. I would just want if you can you have done your research on startups and all. So just one area where young entrepreneurs, not like me, but who are below 30, who are in college or dropping out of college and to try to open garages, and what one area would you suggest them they should focus on? When I say area, I don't mean, I want you to say the industry, given the inflection point where India is today.
Thanks for the question. I've written a whole chapter on it. It's a little nebulous. I think this can be a whole book. I wish I knew that. I'm an entrepreneur. I'm in my late 30s, but I would like to believe that I still have it in me, and I'm on to my new startup. So no easy answer there, but I would say the place where I start usually, I'm betting my career on a global tech company, B2B developer tool that applies globally, a global tech play, out of India. That's very important to me. And I think there's plenty of opportunity there. I would actually bet that the next billion-dollar Indian company that goes on NASDAQ will actually be a B2B company, not a B2C company, a B2B product SaaS company. The way I look at this for myself as an entrepreneur, last 15, 16 years is, where do I see problems in people's lives and companies' lives? Where do I see problems in the customer's life? And what are problems which I feel inspired to solve? What are problems which I think can be solved through technology at scale and so on? And in India, there are problems all around us, right? So there are so many problems that we deal with. We don't have to be imaginative like in a developed country to understand what problems need to be solved. So I would say start there.
Okay. Thank you. Just one clarificatory. What does out of India mean?
I mean global market. Out of India as in based in India.
Okay,
Sorry.
okay. Thank you.
My
Clarify.
Silicon Valley language.
Pass the mic to the gentleman behind you.
You talked about responsibility by investors and companies. Let's talk about healthcare retail companies in India. Companies which are positioning themselves as marketplaces for selling medicines. Now, that is obviously a clear violation of the regulations with regard to selling of medicines. I see global investors who come and lecture us about being compliant on environment, social, etc., putting money into these companies, which clearly is a massive risk, because you cannot wash away your responsibility of delivering a medicine which can be fatal to somebody. Do you have any comments on that?
So for global investors, there is this thesis of, here's this company in China, here's this company in the US, here's this company in this part of the world which has just gone public, or look at the valuation jump they're getting, this is a brilliant idea, this should happen in India. We're looking for that space, that cross in that matrix needs to be invested in right now. If I don't do it, somebody else will. That is usually the driver to all of these investments, primarily global investors who don't have a solid decision maker on the ground here. So that's how it starts. So you want to invest in that space. And then as an afterthought, you want good behavior, you want integrity, you want compliance, you want all that other stuff, but the decision's already made. There have been times where the local fund managers, so many times in 2014 and 2015, a bunch of these deals that were done by global investors, there are really large private equity firms with Indian fund managers. They looked at all these deals. It's not like they were sleeping or they didn't get access to these deals. They looked at all these deals and passed. And they passed either because the valuation wasn't acceptable, or they passed because there were certain diligences that either failed or they were not allowed that time to do that diligence. And these were red flag items like the ones you're flagging, but somebody was willing to write that check. And once they write that check, they say, keep growing. Sure, also look at compliance. It's very important. Like you said, they'll come and lecture you on it. But keep growing, because that's what we've promised to our investors. That's what we want to see. So, I think it's a huge issue.
Yeah. Hi. Hi, this way. Just on, you spoke about, obviously, the negative margins that large e-commerce companies have been doing in India. So the Indian consumer is always said to be more value conscious. And with these huge discounts, everybody's flocking to the internet. Once these guys at some point in time, maybe 1-2 years down the line, the discounts start to dry up. So do you think the consumer will chase internet and e-commerce purchases, or the Indian consumer is very, very, very flexible and just going back to brick and mortar where you can touch and feel stuff and buy accordingly? So do you think once they start to really focus on profitability, the consumers might just roll back and move towards options they always had in the past?
Brilliant question, I think, on everybody's mind. I think there'll be some sucker willing to sell it at a discount, unfortunately. Let's say that doesn't happen. I think the Indian consumer doesn't pay for convenience, they pay for market access. In order to make margins, you need to bring some market access, which either comes through innovative merchandising or innovative distribution. So you're getting the market to a place where it doesn't exist right now, and that's when margins will come. I've learned this the hard way while running an e-commerce company, which I was trying to make profitable. Charging for convenience just doesn't happen. And I wish that was not the case. I know how I consume in the US. The same guy 24 hours later, and here's my Amex, and I'm swiping it everywhere. And in India, I behave differently. I don't think Indians pay for convenience, and if you're making a bet where your margin model relies on consumer paying for convenience, it's not going to work out. If your margin model relies on adding cost layers on top of, let's say, a soap that's being sold in a Kirana store, and he doesn't have a certain cost, and you're introducing that cost, and you don't know how to get that out of your margin, it's just not going to work out at scale. So yeah, I think it's people will revert to going back to old behavior if the discounts go away.
Okay, that brings us to one final question, and then we need to end.
A couple of questions. You spoke about e-commerce guys saying that, okay, we like Amazon. So one is answer that in relative to Amazon India, which I again understand is making losses. So the other thing is that a lot of these numbers are public knowledge. Yeah. So you really don't know what's making money and what's not. The other question I actually have is a little more generalistic. I find all these models actually making losses right now. So it's only saying, oh, I will make profit somewhere, but you have these huge valuations happening. So a lot of your war chest is actually going in funding operational costs. I'll take an example of an Uber or an Ola. I mean, if I compare it to a black and yellow in Bombay, for example, it's obviously far cheaper today. So I get a very nice AC car, but I at half the price of, let's say, a black and a yellow. Now, obviously, it's not making economic sense. Somebody is making losses, and somebody is using these war chests or whatever money that they've raised to fund these operational losses. How long can that last? So is it just about consumer capture, saying I'll become so used to it and sell off my car that I have no other option but to depend on them? Be it a brick and mortar e-commerce or even some of these rides. I mean, is that the game? And because I'm sure all of these investors are not silly. I mean, they're very savvy investors. So, what's the game? Everybody's making losses today.
Yeah.
Including Amazon India.
Yeah, it's a great question. It brings me back to this moment where somebody asked this question in the Startup India conference. Mr. Nikesh Arora was on stage. And the audience started clapping at the question. There was no answer, and the audience started clapping at the question. And the question was, when will you stop funding these losses? And Travis Kalanick was sitting there, the Uber CEO, and Mr. Arora pointed out to him saying, hey, looks like Travis is also looking for that answer. So I think what's happening is, look, this space is going to happen in the world. India is a territory. For Uber, India is one of so many territories. It's a very important territory because look at the number of consumers, look at the number of drivers. You want to stay relevant in that territory. I'll borrow one of the quotes that the Uber CEO made in his India visit is, subsidies are a Chinese invention. He said the Chinese invented subsidies and negative operating margins in China. He didn't substantiate that, and he said that's a Chinese innovation. I actually believe that there are reasons why it works in China. It's a very different market than India. They have shown that they can come back from operating losses to, maybe because there's infrastructure, there's homogeneity, there's nationalism, a closed policy framework that wants local players to win. Maybe there's a production economy that controls margins at the end of the day beyond anyone else's belief. But, I think what the American players are trying to do and what the foreign players are trying to do is stay relevant in this market because the territory is important. They're not taking the lead in the discounting, but they are doing enough to stay relevant, and they're waiting for these funds to dry up. Now, what happened with the Alibaba and JD IPO is these are just really large amounts of funds. And I'm taking JD and Alibaba as two examples. There are many more that created liquidity. Now with, starting last August when the Chinese market faltered a bit, and now, it bounced back. It was the biggest dead cat bounce I've ever seen. And then starting December, Jan again, the entire, global market started, showing volatility. We are very connected in those markets now, more than ever before. India is part of the global tech economy more than ever before. That contagion spreads to us very fast, both on the up and the down. So I think we're all waiting for these things to subside. All said, I believe India is an important territory all investors are playing this game of who will stop the nuclear holocaust first. And by definition, the last man standing with the most amount of funds is going to win that part of the war. I would say stay away from that war. Let it settle.
Okay, on this note, we need to stop.
Thank you.
Kashyap Deorah, thank you very much.
Thank you.